Hey everybody, it's Mike Weller from the Weller Group of Keller Williams Realty. We are here for it's our May 2022 edition of Momi's Monthly Mortgage Moment. Hi, Momi.
Good morning, Mike. How are you?
I'm good. How are you?
I'm doing well. Thanks for asking. Yeah.
Thanks.
Tell me about your red shirt.
So for me, it's today's Keller Williams Red Day. Every May, we do a day of community service, and today we're going out to a charity in Brea and helping build some toys for kids. So I'm heading out shortly after we record this video. So that's why
Awesome.
I'm not just sitting here in a red t-shirt. It's for a purpose. So
Well, you do a lot of stuff for the community in general, even not related to Keller Williams, your Alzheimer walk and a lot of things.
Yeah, we try. We have a few causes that we really like to help out: Alzheimer's OC and Brothers on a Quest, research for ataxia. Those are kind of the main ones. So yeah. Anyway, so here we are, May 2022. We had a little conversation offline. The market I hesitate to say the market's changing and shifting. It is changing and shifting, but that kind of can be misinterpreted to like, oh, the market's, like to shift into a buyer's market or crashing. That's not really what's happening, but the market here in May and going forward the next couple of months is different than it was 2 or 3 months ago. Some of that's the interest rate change. Probably that's a fair amount of it. We're also seeing more inventory come up, although it's still a very low inventory market. This is all on the real estate side. I guess the interest rate is more than just the real estate brokerage side of things. So me pause, you talk. Jump in, give me your perspective and feedback, and don't give it to me, give it to everybody else out here who's tuning in just to hear your wisdom.
Yeah, well, so I agree with you, Mike. I have a lot of clients that call me, I think we're in a bubble. I even have other realtors that say, I think we're in a bubble. And you and I have talked about this a lot. Certainly the market that we are in right now and that we're going into is very, very different than last year. And then, like you said, the past 3 months. But you and I have also talked about, and I firmly believe that in the next maybe 3 to 4 months, we are going to see you're already seeing more inventory. I'm already seeing more inventory. What I am seeing of the inventory, at least in my area, I live in North Tustin or Santa Ana, is that homes are on the market for a lot longer. There's actually price decreases, and they go into escrow and then they come back on the market. And I don't know the reason for that.
Right.
But there are like 3 that have been on the market, went to escrow, and came back on the market. So who knows why? But maybe the buyers found something different. Although I don't know that you could cancel a contract for that.
Right.
But I do see more inventory coming on, and I think in the next 3 months we are going to see that. We won't see as much of a seller's market. And yes, we've got higher rates, higher prices, and high inflation. High inflation means higher rates. And so it is a very challenging time to buy right now in this market. But I think if people can hold on and get back in the game, they might reap some benefits in the next 3 to 4 months with more inventory, not as many offers that they're competing against. It's going to be more of a normal market, not a seller's market, I guess is what they've been calling the last year and a half, right? Yeah. Seller's market.
Well, so a couple of things as far as you're seeing listings stay on the market a little bit longer. And so I think sellers have gotten conditioned to now pricing their property really high. Mm-hmm. And this is like one of the rare times where we've had a little, maybe a 4 to 6 month period where that actually didn't burn them and it actually worked. Like, oh, the guy down the street just sold his house at 1.2 million. I'm going to list mine at 1.3 because it's 6 weeks later. And from, I don't know, October, November, maybe November, December until 6 weeks ago, 2 months ago, sometime in March, like it would actually work. That actually wouldn't kill them. In almost any other time, you can't do that. So sellers, I think their expectations got out of line a little bit. Some of these listings are going on way too high. And now with interest rates going up, buyers are, I think buyers are getting a little bit more they're just pulling back a little bit more and taking a deep breath a little bit more. And also some buyers, because of the interest rates, they have to adjust their price point, what they can afford. So
yeah,
I think that's causing a little bit of that. And, some sellers probably need to just have a little bit of a reality check and adjustment there. And it's, as me and agents, it's our job to kind of help them get there. So that's that part of it. As far as things falling, you're seeing some more properties come back on the market. We actually had a listing recently that it fell out. We had to sell it 3 times. It fell out twice. Now it had some issues beyond normal inspection stuff, some foundational stuff that we had to work through, and that's a big reason why. But again, we went through a time period where buyers were buying anything as is. They had very little leverage to negotiate repairs, and as interest rates have gone up, maybe buyers got a little bit more hesitant on, well, you know what, I want this seller to fix this roof that needs $6,500 worth of repairs. And again, that same seller still hasn't kind of had a little bit of a reality check, and there's been a disconnect there. So that's kind of all of what you're seeing there. But yeah, I think going forward the next few, and certainly year over year, compared to 2021 and compared to, not this point yet in 2020, but compared to 2020 from like Memorial Day and beyond, like when the market really started getting going after the initial COVID lockdowns, our numbers are down, but they're not down significantly from previous years from that. I mean, last year and the second half of 2020 were just crazy. I mean, the numbers are down this year, and a big part of it is there really hasn't been a whole lot of inventory to sell. So
yeah,
that's one of those things that gets misconstrued a little bit, like, oh, the market's softening. Well, not really. It's not really. But going forward the next 3, 4, 5, 6 months, it's going to be more of I think it's still going to be a seller's market, but more of a normal seller's market. Maybe it gets to like somewhat of a neutral market, but I mean, the last 6 months is like such an outlier kind of market that, is crazy. So you can't really.
You mean the last 18 months?
Well, yes,
really?
The last 18 months, but the last 6 months, like took it up another notch, even from, the second half of 2020 through, last fall. So
yeah, I think
yes, it was a crazy 18-month run.
Yeah, it was a crazy 18-month run, even 2020. And I think what happened this year is, Fannie and Freddie, they all added those loan level pricing adjustments on high balance second homes and investment homes. And so we're seeing way less of those being bought being bought, right? Because the rates on those are astronomical. I mean, sadly enough, I have some clients, some buyers that are buying new construction, and they signed their contract last year. I mean, I have some in the millions, right? When rates were in the high 2s or low 3s for that type of a property, second home, or even these were all second homes because they're in resort areas outside, like in Colorado or Utah, so $3 million, right? Well, when you're looking at a rate that's in the low 3s, that's a very affordable payment. That's very easy to do. But now, because it's deemed a second home and we have those loan level pricing adjustments, you're not looking at a rate in the low 3s. You're looking at a rate that, I mean, it might be in the high 5s because of all those pricing adjustments. So, going back to what we were talking about as far as, high rates and people's affordability, what I am seeing a lot of, and I don't know if you've heard this or any of the buyers that, or with any of the buyers that are dealing with your listings, adjustable rate mortgages are very in right now. The 5-year and the 7-year, they're an entire point below what the 30-year fixed rate is right now. So if your 30-year fixed rate, I mean, just it was up in the mid 5s, from last week. It was like 5.3, and now it's over 5.5, right? Week over week. If you can get an adjustable rate that's 5 or 7 years, that's a whole point lower, and your affordability factor is still there, your purchasing power is still there. anything can happen in 5 to 7 years. You can always refi if there's another refi boom, which I suspect there will be. Right. We talked about the Feds raising the rates. We talked about that last month, and they raised it a half a point. I think it was the day that we talked not the day we talked, but they did raise it a half a point in May. They are expected to raise it again in June and again in July, right? Yeah. I don't know what the June number is, but it's, they were saying another half a point in June. I don't know if you've heard if it's still going to be another half a point. And they're saying maybe even 3/4 of a point, right? They want to get inflation in check. When the Feds raise their rates, it does not mean that they're raising the long-term mortgage rates.
Right.
I'm sure you've heard that, right? Or your buyers have told you, oh no, they're raising the rates.
Right. It doesn't automatically mean the Fed raises the rate half a percent. That doesn't automatically mean your mortgage rate is going up a 0.5%. That's not how it works. Yeah.
And it does not translate into long-term mortgage rates. When the Feds raise the rates, it translates to short-term rates, like your lines of credit against your home equity lines of credit that you would get from your bank that are usually in second position, right? Your credit card rates, your auto financing rates, those are the rates that affects when the Fed say they're going to raise their rates. It actually has the adverse effect on long-term mortgage rates, because the higher the inflation, the higher the rate. As the Fed start raising their rates, they do that to keep inflation in check. So as they raise their rates, the need goes down, and our rates will actually go down as the Feds raise their rates, because they keep inflation in check. So as they raise their rates, inflation will start to go down. We will see inflation start to come down, and we will actually see rates start to come down. I mean, do I have the magic crystal ball? No. But if they're raising in May, June, and July, I suspect in September or October, we will start to see long-term mortgage rates come down. You talked about the market coming back to more neutral.
Yeah.
So prices not going up as much as they were, right? If prices kind of, I don't know, can we use the term stabilize, Mike?
Yeah, I think they're gonna so I don't think there's going to be a crash. I don't think the bottom is going to fall out of the market. I don't think prices are going down, especially like in an inflationary environment like we're in. But I could certainly see appreciation pulling back to somewhere around the inflation rate and not outpacing inflation.
Agreed. So inflation is what, 8.8% or something like that today.
It's in the 8s.
I agree.
Yeah.
I think we're going to see single-digit appreciation rates, nowhere near like you and I have talked about in previous videos of 20%. You had one community that was like 27% or something like that. Crazy.
Oh yeah. I mean, so if you really if you really search and everything, you could probably even find numbers higher than that. But yeah, one of the communities.
Yeah, I mean, Phoenix is in the 30s. Denver, Phoenix is in the 30s, but maybe high single-digit appreciation coming up, and lower rates in September, October. We're probably headed into a recession. If all the data stays the way that that we're reading it properly, we're probably headed into a recession, which actually helps our long-term mortgage rates. And then I think people that kind of put their buying on hold can get back in the market.
Yep. Yeah.
Because the affordability factor is there. Their purchasing power will be there again. They won't be contending with, I mean, I don't know, 25 different offers, all $100,000 above list, right?
Right. And that's tempered now. Like that's tempered here over the last, month, give or take 4 6 weeks. So, a buyer in some ways is actually in a much better position now than they were 2 months ago, as far as it's less competitive. They have a little bit more of a shot, but the rate is higher for them. So that's their challenge there, obviously.
Yeah. Unless they're willing to look, I still find that some of my buyers are not willing to look at an adjustable.
Right.
I understand, because they think about what happened in 07, 08, right? Those really weren't adjustable rates. Those were like the NAGAM, where you weren't even making
those are teaser rates, even like for a year, 2 years. So the ARMs, the adjustable rates that you're talking about, are typically like 5 or 7 years.
5, 7, 10. And, you know, let me just do a really quick 10-second explanation of it. What that means is it's fixed for 5 years, fixed for 7 years, fixed for 10 years. If the rate is, I'm just going to throw a rate out there, 4.5. I'm not suggesting it is, but let's say the rate is 4.5, 7-year adjustable. That rate is fixed for 7 years, and then it starts to adjust based on the index, right?
Yep.
But if it's fixed for 7 years and the rates go down considerably in the next 7 years, which chances are we might have another refi boom in the next 7 years, right? You can just refi out and get into a 30-year fix. I mean, I will say that most of my savvy buyers, my high-end buyers, my self-employed, very successful business people, they would rather do an ARM than a fixed. Because they understand it. They understand the concept.
And also, if you're buying, you know, maybe it's your first purchase, but you know it's not, this isn't my forever home. This is our, you know, our entry, we're buying our entry level townhome now. We're going to be here 3 to 5 years, and then, you know, we're going to outgrow it. And, but, you know, then also the ARM is the way to go. Even if a refi opportunity doesn't come up in the 5 years you're going to be there, you're going to be in better shape than, So
no, absolutely. And then I also have oh, I'm sorry, go ahead.
I was just saying it's a case by case. Everybody needs to sit down and figure it out and talk to somebody like you, so that can kind of walk them through it.
It is case by case. And you know, when I pre-approve somebody, or even when I send one of our buyers numbers, right? Like if they have a property in mind and they want numbers, I always give them options. I give them 3 or 4 different options: rate buy down, an adjustable rate, a fixed rate. The other thing I wanted to mention, not only the ARMs are very popular right now, but the interest only, because I can qualify somebody on an interest only payment. And that keeps their purchasing power or their affordability relatively high. And again, okay, you're not paying principal down. You can pay it down on your own if you want, right? You can throw an extra, you know, $500 or $1,000 towards the principal every month if you want to. But again, those are typically fixed for 10 years, or you'll have interest only for 10 years. You know, again, you have the ability to refinance over the next 10 years, or if it is your starter home, or you're not going to stay in that home for more than 5 years, consider that. Consider an interest only.
I think it's also a case by case. I think that the interest only, my feeling is for maybe a little bit more of a sophisticated buyer / borrower too. But it has its place. I think it has its place. It's not for everybody, but it has its place. So.
Again, I'm not offering the NAG-AM loans that we had in 07, 08.
No, definitely not.
Even making an interest only payment, right? You weren't even making an interest only payment. And you're right. It is a case by case, but again, I will always give our buyers options. That's my job.
Yes. So, okay. Well, you heard it here first from Momi. Interest rates are going to go lower later this year. That's what you said, right?
Yes. Lower inflation means lower rates. Recession on the horizon means lower rates.
Okay. You're putting it out there. So
putting it out there.
We'll check back May 2022. So we'll have to bookmark this and come back, see. So
we haven't been wrong. We talked about inflation for many months.
We've been dead on inflation for a year, 13, 14 months or so. We've certainly been more correct about it than, well,
the media
and
the feds. I'll say it.
The media, the feds, and and the
general public. They only know what they're being fed. It's, you know.
So
we're feeding the truth.
I was going to say our politicians too. So.
Oh.
Yeah.
Okay.
So. But okay. Well, that's where we're at, May 2022. So, thank you, Momi.
Thank you, Mike. As always, I appreciate the opportunity to spread knowledge.
I'll try to get rid of the shadows when I'm back here next month.
It looks great.
So, all right. Take care, everybody. We'll see you next month.
Bye.